All right, so like I said last week, your exams will be on Friday. In class on Wednesday, we're basically just going to review. The review sheet, if you haven't seen it, it's already up on Canvas. There's a ton of questions on there. I'm not sure the number. I'm just going to select 6 of those questions. They're very similar to those questions for the exam. Yeah, so if you have any questions, like going over it, we'll talk about it in class on Wednesday. I won't be here on Friday, so I'll have the GA like Proctor for you guys.
Group test?
No group test.
That was the best. That was one of the best.
All right, so today we're going to talk about the second chapter in Money Free and Unfree. It's central banks as a source of financial instability. So again, a lot of this book contains history to help develop like these narratives and the theories that they're talking about. So in this case, George Selgin's going through the origins of central banking and how central banking, how they first started out as just like typical banks. Then they got special privileges. And then because of special privileges, they needed extra responsibilities, like being lender of last resort, and how that turned into modern central banking. He takes a very negative view of central banking, and he cites Walter Bagehot, with he came up with the theory of the lender of last resort and how lender of last resort is supposed to function, and that's actually what the next chapter is going to be, talking about the lender of last resort in more detail. So before we get started, I just want to remind you some basic questions to keep in the back of your head while we're talking about this. So like, how well does the author make the points? Do you think their argument is valid, or do you think it can be done better? Do you agree or disagree? Do you think they fail to take something into account, or do you think part of what they talked about was more important than what they thought? What lessons can we learn, and how can we apply this to policy today? Again, does this even matter? Feel free to argue that you know this is old stuff. It doesn't really apply to the world today, if you really believe that. And then if there's anything you don't understand, feel free to ask questions about it, and we can figure it out as a class together. So with that, I'll just open it up to you guys.
I don't want to get the ball rolling for it.
So there's something I wanted to talk about. I do think it's very ironic that Walter Bagehot was against central banking, and he came up with a theory of lender of last resort, how they should function. So you lend to illiquid banks that are still solvent. So they're having trouble with having enough currency in the short run, but they have enough assets to repay those loans. It's a very simple rule for being lender of last resort, but central banks continually mess that up and don't adhere to it. Especially during like the financial crisis, the Federal Reserve would bail out insolvent banks. They let other banks fail almost randomly. If you guys watch South Park, the Margaritaville machine episode, where the regulators just chopped off a chicken's head and it ran around a board, and wherever it fell, that's what they did. Sometimes it seemed like the Fed policy was very random during the financial crisis. I mean, if you watch or read it, but it's easier to watch. Too Big to Fail by Andrew Ross Sorkin, where he like details what's going on in the financial crisis. You can't blame them for their actions seeming so random, because it was like one catastrophe to the next, just like constant. Like, oh shit, this is blowing up, this is blowing up. So it would have been an incredibly difficult environment to try to make decisions. But still, Walter Bagehot not only he comes up with these rules that they don't listen to, and then they use him to argue in favor of central banks when he actually didn't like central banks. You have to appreciate the irony of that. So they talked about a little bit towards the end, comparing Canada and the United States. The United States, in the late 1800s, early 1900s, didn't have a central bank, and neither did Canada. But we had two totally different experiences with our financial system and with our money. They have a nice graph on page 34. So, do you guys think the Canadian system works better? There wasn't too much information in here. They don't like dig into it too much. But how do you feel about the Canadian system compared to the American system?
Looks like the Canadian system is a little bit more controlled and stable.
Yeah, you see generally like a pretty stable money supply, a long run trend. There's obviously big seasonal differences, but that's because mostly due to the harvest season, farmers demanded a lot more paper money so they can like repay their loans. So you see it every year, it jumps up that time of year and it drops back down. I mean, the United States is a lot larger than Canada. Even at the time, we had a much more developed financial system. So do you think some of Canada's success could be due to just what Canada was, just a smaller country compared to us, or do you think it was actually a better system?
I mean, I'm not too familiar with this time period, but I'm pretty sure that we're probably engaging in more risky investments. So I grow. Make full service, right?
So you think there was more going on than just the type of banking systems we had?
Yeah.
I think it even speaks on how the difference between 1800s starts it was just shot at Canada. And the consistency of it just shows that they were very steady in the processes for almost 30 years.
So you're saying you think that makes Canada better, or they were better in that regard?
For consistency.
Yeah.
But I think
That's always a good
they
thing.
weren't missing. Industrial revolution was coming around, right?
That was more the 1800s. Oh, I don't know when it took hold in Canada. I would be interested to see the money supply as like per capita,
Yeah.
because how many more people were there in the United States and Canada at the time?
Business was also a large influx of increase as well.
Yeah. So the population in America is growing substantially in the early 1900s. That increase in the money supply isn't that big of a deal.
That's another good aspect of it. I don't think this graph really incorporates everything that it should.
Yeah.
It's like running a regression of how, putting in.
Any control variables.
You're just kind of like, wow, this doesn't tell me anything.
Yeah. Yeah, because there's so much other stuff going on. And I think one of the later chapters he gets in like more details comparing the United States and Canada. This is one of those things he just kind of mentions briefly and touches upon, but if you don't read more of Selgin's stuff and know his arguments ahead of time, then it's just kind of, I don't think it's very convincing. I will note a couple times he mentions Humean price specie flow mechanisms when talking about the classical gold standard. And that refers to David Hume, an early economist, who described how the international gold standard worked. Basically that there would be disequilibrium of prices between two countries. And because of that species, so the actual gold and silver, would flow out of one country into another country, where it could be used to buy relatively more goods. And by doing that, it would bring the prices back into equilibrium over the long run. Obviously, in a fiat world, that sort of international equilibrium process isn't going to exist. We just have exchange rates between currencies that are going to change over time. So in that regard, fiat currency is a lot simpler. In case you didn't know what he was talking about at the very end of the chapter, that's basically what he means. First we see flow is. I said he takes a really negative view of central banking. He calls them the Pied Pipers of credit. He basically argues that they're what made the economy so volatile and what makes recessions so frequent. I know it's still early on in class, but do you guys agree with that, or do you think he's taking too negative of a view?
I think you might be making it too negative of a view. Just because you might at least trying to do something that like, is trying to make it less volatile, I guess.
Yeah, that's kind of the goal of central banking is, I think it was William Chesney Martin said, to take away the punch bowl right when the party starts to get going. That they're trying to make the booms not as sharp, so that way the crashes that come afterwards aren't as bad. And in theory, it can work very well. Even like in the 90s, Alan Greenspan, they call him the maestro because he did a perfect job of increasing interest rates right as the inflation started taking off, GDP growth was really high, smoothed it out, and then we didn't have a recession from it. But then you get the Great Recession, which at least had some of a role in creating it.
I feel like he starts talking shit on fiat money and how central banks are, these monopolistic entities. It says the gold standard was better. It doesn't say to provide any evidence backing this claim.
Yeah, and
I mean, really.
yeah, this is based on a lecture that he gave.
Yeah.
So it isn't like a typical like journal article. But you're right, and a lot of this stuff is like stuff he writes about all the time
Yeah.
and just assumes the audience, and I'm sure the audience at that conference knew exactly what he's argued in the past.
Yeah.
And as that, but if just literally reading this, like, really, did you really prove it?
Yeah, I mean, I'm sure he has some points, but like, just like on my, like, I'm just like, we really assume that it doesn't get any better. Keep reading more.
Do you think we could live in a world today without a central bank?
Yep.
Yeah.
Do you think the economy would function well?
No.
I don't know what would happen. It'd be a big run on something or other, but
I feel like when we first went back, or like I guess we get rid of the Federal Reserve, that first period of time, I don't know, maybe a year, however much time, there could be chaos
could
of
be.
people freaking out and having a lack of confidence. So they're run on all the banks because they don't know what's going to happen. Even if it's nothing wrong with the financial system itself, it's just people being scared. But there's so many times through our history that central banks have made mistakes.
I bet if like we didn't know that the Federal Reserve disappeared,
It was a secret.
like if it just disappeared one day and nobody knew that it was gone, a lot of things would just stay the same.
They just took a year off. Randy, you were shaking your head no. Let me ask that.
I just don't think it's feasible. We've had it for, what, over 100 years now?
Yeah, just over 100 years.
Whenever something's been around for 100 years, not too many people like when it changes. They get pretty used to it being there and having that type of people. That'd be like the United States government just collapsing and then everybody thinking, oh, everything's gonna be fine. Like the period afterwards, which, like you said, would be like total chaos.
Yeah.
Even if nothing bad was gonna happen, it's just the perception of it that would make it bad.
Yeah, and unfortunately, people's perceptions and their expectations have a substantial effect on the economy. So if they lose confidence, they're gonna stop spending money, save it just in case. All that consumer spending drops, GDP is gonna drop, we go into a recession. Like, it's so easy for people to lose confidence for that kind of stuff to happen. But do you think it would have a substantial impact on like the real economy? Away from like expectations, do you think we'd see worse crises or fewer crises?
I don't know. Just because it seems like before we had a central bank, there were crises, and then when we had a central bank, there were crises. And then he said that they were worse whenever we had the central bank, but I don't know.
Yeah, there's very little evidence of it being worse,
Yeah, so,
which I wish he would have went into a little bit.
Let's see fewer or more recessions, but not as drastic.
I think there'd be a lot more like shallow ones. We'd have a more variation in GDP growth over time. We're going up and down, back and forth, but it's not huge swings.
Right. I think that just like that emotions factor, where people, as soon as they lack confidence, it will trigger something that doesn't really need to be triggered. And that would create the effect that would want to shock recession.
Do you think the financial system would still operate smoothly without the central bank?
There would have to be a lot of adjustments by like the commercial banks. I think, in theory,
What do you think?
This is really tough. I actually didn't think of this ahead of time. I thought of like while we were talking. So I didn't develop a really good idea yet. But like I said, I would be worried about the process of getting rid of a central bank. Would people still have confidence in the economy? 'Cause, yeah, if they don't have confidence, they go run to their commercial bank and withdraw all the money they can, and they panic.
And what do they do with their cash?
They do two things: either hold on to it, or if they think it like collapses imminent. Sorry. They might just do what they do in like hyperinflations and like buy all the goods they can like immediately with that cash, and then trade amongst themselves, which is bad. And they run to the bunker in their backyard and like try to wait out the apocalypse.
It's not even worse than saving it in the bank.
Yeah, it does. But if you think everyone's going to pull their money out, then you have to pull your money out.
Or you rob people.
In
once
this
they pull their
situation,
money out.
everyone's acting rationally, taking the money out just for themselves. They're acting rationally. But as a whole, it's irrational to want to run and pull your money out.
I want to pull all my money out of the bank.
I think I agree that that we'd see more recessions, but we'd see them be a lot less severe. You wouldn't have problems with, you wouldn't have the same sort of like financial crises that we've experienced with the Federal Reserve, especially if they keep interest rates too low for too long. That was one of the causes of the financial crisis. That helps worsen recessions when they do occur afterwards. People take out loans or like they lend to people that they really shouldn't. The profit appears to be higher because interest rates are artificially low. And once interest rates move back up to the neutral level, like where they should be, these projects that were once considered profitable now are no longer profitable. So like the banks are losing money, the people that borrowed and the firms that borrowed now have to pay back, and they're not going to have enough money to do that.
I think that greed would be a big thing to the hands of the commercial banks. If there weren't central
But what about Canada, who didn't have a central bank? Private banks issued currency, and they didn't have the same problems.
Were the banks bigger than things?
Their banks were bigger.
Really?
So Canada historically, and they don't talk about it, at least in this chapter yet, they had like 6 large banks and then some smaller ones, but they had branches all over the country. So they were well diversified. In the United States, we had what we call unit banks, literally just one location.
What do you mean now?
Now,
Is it worth-
our biggest banks are bigger than their biggest
That's what I'm
banks.
saying. If you-
I don't know what the concentration is between Canada. I think they still have greater concentration.
But what I was getting at was you
We have more small banks.
Yeah, the U.S., we were the Federal Reserve, and I was agreeing with Jake, our banks were so big, it sounds like I just feel like they're trying to do that.
One bank makes, well, not one mistake, a series of mistakes. Washington Mutual. That's such a big part of the financial system that they go belly up. That's going to have effects for everyone, right? That's basically what you're arguing. So you need some sort of lender of last resort there to backstop those banks. Do you think that causes a moral hazard problem? Where because they have the Fed who's going to step in and save them, they can make riskier loans?
But they also keep them in check. For instance.
What's, I don't know, incentive is greater, do you think? The Fed keeping them in check or the moral hazard?
I think that nowadays, there's so many checks and balances on Wall Street, they can't work the system like they could before. But I think that
I would just do that after reading the Basel and everything. I think that's just not the case.
Yeah, basically private bankers designed the Basel Capital Courts.
Yeah, so they.
Private bankers from the US and from the UK, not even like the other countries.
International banking scams to try to, help combat that, and ended up just engaging in like even riskier capital arbitrage and causing, inadvertently causing the banking crisis.
so you think that maybe you just take advantage of that.
What's the revolving door aspect of that? It's,
Yeah, so when you have regulators overseeing an industry, you need people who are well versed in the industry that know it inside and out. So you have to pull it from these private institutions, so in this case from banks. But they all obviously have friends at those banks, and after working as a regulator for a few years, they normally go back and get a promotion. So they call it the revolving door, going back and forth. A lot of times they call Treasury government sacks because so many people from Goldman end up working there. If you're going to go back in a private industry, after you're regulating someone, you're going to want to take it easy on them. So they have incentives to not regulate as strongly as other people think they should. They have incentives to help those firms that they're going to jump back to in the future.
Do you guys think that Wall Street's still corrupt because of the system?
They design the system as much as they can for their benefit. And this goes back to the Interstate Commerce Commission back in like the 1880s, regulated railroads. Because railroads basically had a monopoly from one location to the next. Well, it turned out all former railroad employees started working for the ICC, regulating them, and they ended up. It was called they were captured. It's like the industry basically controlled them. So when like 18-wheel big trucks were used much more commonly to ship goods between places, the ICC put a lot of restrictions on them to help the railroads. So instead of preventing monopoly in railroads, they helped strengthen the railroad monopoly.
Love to see it.
Incredibly ironic story.
So one of his big claims is that the central banks they had certain privileges and powers which they currently use to correct the economy, but in fact the fact that they have those powers is the fact that the economy is destabilized. And I wasn't quite sure what his examples in the bank thing were that caused destabilization.
Yeah, so the Bank of England is a really interesting example because it was the first lender of last resort. Became the first real central bank. But he kind of goes through how it was an accident. They just gave them, was it the currency issuing privilege was the first thing they gave them? I don't remember where it said that.
Yeah, tonnage act,
Yeah.
securing certain recompenses and advantages.
Yeah, they got that because they would lend to the British government, at favorable interest rates. And then they ended up becoming the central bank, that because people want to use paper currency instead of actual gold bullion to make trades, other banks started holding Bank of England notes instead of bullion in their vaults. So they end up, basically by accident, that wasn't the design of the legislation, but ended up removing the gold basically from the system, and Bank of England notes became their de facto currency. Yeah, they ended up getting, you had to serve as lender of last resort, which you mentioned they did so reluctantly. Like, they didn't want to be lender of last resort. It was not always the best business decision to be lender of last resort. So he blames, without, really citing the examples, that they became less stable because of the
Because
banking.
the ton of jacked,
Yeah,
and then they removed gold, and then they had to lend out because they took away all the gold.
basically, yeah. I really hope he brings that up later. There's one, Scotland had a free banking system, even when they were part of the United Kingdom for a while, where there was no central banks, and banks would issue notes privately based off of the gold in their vaults. And the system worked incredibly well until they passed one piece of legislation giving one bank like a slight special privilege, and then ended up unraveling the whole system. They ended up, having your typical banking system with the central bank. We imagine a lot of the central banks today were basically their goals and their structure the same as it is now. And what this chapter, one of the things this chapter points out is that's not entirely true, that they were designed to do other things and they kind of became central bank over time. Central banking as we know it. I think that's sort of the subtext of this chapter, is that it causes financial instability because these central banks weren't designed originally to promote economic stability. They were designed to lend favorably to the government. And then it turns out that's because of that privileged position, they needed to start acting like what we think of the central banks.
I was curious to see, like, according to history, like how many recessions and depressions there were, like with the current central bank system and before. For the first 100 years under the Fed's control, the United States has had 22 recessional years, including one depression. The 100 years before that, the Fed saw 44 recessions and 6 depressions. So, like, it seems like they're, according to history, having some type of central banking system is better than, but that's, but the world's different now than it was 200 years ago.
Yeah, that's for sure. And I think that's the hardest part about this is just this discussion is the world was so different when we didn't have central banks. Is it even applicable to look at this history? It's just like that was such a different world, it's not going to apply. One thing he does note, and they talk about that later in the book, about the United States system, because we have the unit banking laws, it was so fragile. And he mentions at the very end, the U.S. dollars were tied to the government debt. So the state chartered banks would have to keep, for every dollar they issued in currency, they would have to keep $1.10 of government treasuries in their vaults. And as the government tried to pay off their debt after the Civil War, that reduced the money supply. So we had deflation for 30 years because of that system. Again, that was just, they designed it to make sure that during the Civil War, the government wasn't in massive debt, that they could have someone actually buy it. And it turned out to decrease the money supply over 20 years. So some of the problem with all those recessions was due to that policy.
Yeah.
But how much of it was due to that policy? And what does central bank have been able to fix? The inspiration for the Federal Reserve, part of it was lender of last resort, after JP Morgan had to do it himself. The other was, and the legislation says this, to establish an elastic currency, because they recognize this seasonal problem. So definitely, the Federal Reserve had an opportunity to improve the system, the financial system, by offering a more elastic currency. And if you look at M2, M1 or M2, I don't know, if you look at currency afterwards, after its creation, it does become much more elastic. So in that regard, it was a success.
Yeah.
You didn't? Why not?
I'm sure. It's kind of like skimming over the top of stuff and said, all right, I'm done with this. Next chapter.
Yeah, it was kind of like like a 1,000-foot view of it. We didn't go into too much detail about this stuff.
I don't think you try to cover too much in this chapter. You should have just maybe cut it down.
I mean, it's good for a talk,
Yeah, yeah.
but to actually
Keep
fit in
forgetting
this
it.
book, I don't know how well. Because he gets into some nitty-gritty stuff later on in the book.
Does it?
Yeah, but compared to this, it's just sort of an overview. And he makes some pretty strong statements, calling the central banks the Pied Piper of credit.
Yep.
Like, that's definitely an insult. But if you're going to do that, then you really have to back it up. You can't insult someone in like an institution like this, and they just kind of just hand wave around.
I guess you could say that that's how the central banks treat everybody else. Make some big claims, say a little bit of stuff, and then walk away.
So he's just playing the game back to them. There's very few good economics books that are really critical of central banking. Most of them either like cheerlead central banking, or the ones that do speak negatively are like basically conspiracy theory books. This is a very narrow segment of literature. One of the reasons why I wanted to read a book that was like more critical of the Federal Reserve, talk about it, was because so much of even just like the textbook naturally indoctrinates you into liking the Federal Reserve.
Mm-hmm.
I have a much more positive view of the Federal Reserve from taking money in banking and from doing the Fed Challenge. And so much of the economics profession just tacitly accepts the Federal Reserve and its role. So reading something like this that's critical, even if you disagree with it, you're still exposed to these arguments. And then it gets you thinking, what's the best way to design a central bank? What's the best way for it to operate? So he's pointing out problems that causes financial instability. You think, okay, like maybe this is a problem. How do we better design monetary policy to prevent that? Do we switch to more of a rule than instead of discretion? So instead of the Fed looking at all these different measures and trying to decide from all of them what to do they just target the growth rate of nominal GDP? Do they use the Taylor rule that takes into account inflation and GDP? Do those cause their own problems, have their own side effects that you need to worry about? Yeah, and I think this is one of those things that just has a very book that has a very important role in trying to think about central banking in general. And also, it's good to remember how things change over time, how the goals change in the Federal Reserve, how the Federal Reserve operating changes over time. Because it's very easy to say, oh, this is what they're doing now. This is how they should operate. But in reality, maybe that's not the case. Maybe there's a better way to go. I mean, they've changed their operating mechanism several times in the past. Maybe there's something better to do. All right, what else do you guys have?
What do you think about this paragraph on page 35? It says, although the advent of fiat money has not rendered central banks any less capable of generating booms and busts, it has considerably complicated the possibility of fundamental reform because a fiat standard must be monopolistically administered.
I think he's generally right there. That without being on like some sort of commodity standard, it's difficult to, and when he means fundamentally reform, he means basically like get rid of the Federal Reserve, or central banks in general. You can't, like we talked about before, you can't have privately issued fiat currency. It just doesn't work. They'll hyperinflate the currencies. That's profit maximizing action. So we need some monopolist to issue currency. The most obvious, and I think the best way to do that is to have a central bank. It's hard to imagine getting any sort of big reform while we still have fiat currency. And it would be tough to get anyone to support that. Again, because of all the problems that it would unleash. That would definitely be chaos.
They have to like pass out like replacements for your dollars, like some sort of note replacement that's tied to a commodity.
Yeah, they would.
That'd be interesting.
Other countries have done it. So like a lot of Central and South American countries, when they hyperinflate, they'll outright dollarize. So they'll just switch to US dollars as their currency. And that goes pretty smoothly. Sometimes they'll just issue a new currency. So all of the old currency will stay in circulation, and they'll issue new currency instead of an exchange rate between the two. And that'll last for some time. Like last time I mentioned the Weimar Republic. When they hyperinflated, they issued that new currency tied to land.
Mm-hmm.
Those traded, I don't know, at a certain ratio for like 10 months, and then they withdrew the old currency out of circulation. I wonder if people in the United States would be able to deal with that, or if they would be too freaked out by it.
Land.
Not just backed by land, but just to go from one currency to another, because we've had such stable currency for so long.
The new dollar.
One type of currency. The dollar's got a brand name. But if you go to Northern Ireland, the part that's part of the UK, their banks issue private notes with
Bank private
backed by the British pound. And over there, people don't have a problem.
Did like a few years ago, India just like say that they're not taking cash anymore? Like everyone's cash is.
They like withdrew all their currency from circulation, and then destroyed it, and then reissued paper currency sometime later.
So it's just a different one?
Yeah, so like a different one. Maybe it was different denominations.
Didn't that do like make everybody just like panic and like?
There was a
That's
decent amount of
what
confusion.
It was seemingly overnight.
There was a recession as a result.
So that doesn't sound that bad. Like,
Yeah,
completely
even-
taking away all cash, and it's not worth anything anymore until the recession.
Yeah, it honestly wasn't as bad as people thought it was going to be. It was kind of shocking. I think that'd be easier to do in the US because we have better online banking infrastructure. More people have online banking apps and smartphones and stuff, and people in India do. So I think that would make the payment process a lot easier. So maybe we wouldn't even have a recession.
Right.
Are you raising your hand or scratching? Oh, but yeah, that India thing is wild.
I was like listening to like a podcast or something, and I heard about it, and I just wasn't sure what it exactly was.
Yeah, I don't remember exactly what happened. You're gonna need to read up on that thing. Do you guys think people would be freaked out by having like privately issued currency from each bank?
As long as it looked relatively the same.
Yeah, they would
people
probably
wouldn't
keep
care too
it,
much.
they'd keep it pretty much the same, pretty much the same across banks, but it would have each bank, like, name on it somewhere.
It'd be like a debit card, I feel like, but money.
Yeah.
So it all has the same value, just different names on it?
Yeah.
What do you think about when you do that back? Sorry. I don't think you could do that back. You guys think?
Yeah, I don't think it would be that bad either. I can see some people really freaking out about it though.
Some people, but I feel like a lot of people wouldn't even, like, there are a lot of clueless people out there, and some people wouldn't even really know.
That's true.
I feel like more than 80% of America doesn't know what the Federal Reserve is.
That's probably true.
I just feel like old people freak
It'd be
out.
like, Federal Reserve.
Old people are still freaking out about the end of the gold standard.
That's what I mean. So like, old people would freak out about if they changed it. So I
How
feel
many
like-
times have you heard an old person complain the dollar's not backed by gold anymore?
Yeah,
That is a grandpa thing to complain about, but then.
that's pretty sad.
What do you think about Mnuchin shooting down the new proposals for the changes in the bills?
I didn't hear about that one. Happened.
We're gonna put like, they're gonna put Harry Tubman on the bill or something like that.
Yeah.
I heard that.
We're gonna take off Jackson.
We're gonna change another bill. And Mnuchin was just like, no, I'm not gonna do that anymore. And they were like, oh, but like it was supposed to be done.
Yeah, like
this
it
year.
was approved.
It was it was before Mnuchin.
I don't
It was before Mnuchin, like said that they were gonna change the bills.
know. Yeah.
And now it's like Mnuchin was supposed to do it because he was the next Secretary of Treasury. Right?
Yeah.
And he was like, no. And they were like, really? You're not gonna? They're like, well, what about?
I hope they didn't start spending money to like get ready for the new bills.
They're like, well, what about?
They probably
What about later in your tenure here? He goes, no. I don't think you'll ever see me do that.
That's just a really bad precedent government wise. Means they didn't follow what the prior administration said. That's a really bad precedent.
Mnuchin was just
I'm
like-
sure that's been done plenty of times already.
Regardless, it's. still
Every
bad.
time it's yes.
If you think about it, that's why you have new.
He's just like, I have
New
a lot
set
more
of people
stuff
in there.
going on. I don't need to focus
Yeah.
on like changing.
Well, on the one hand, it's you elected a different group of people, so they're going to want to do different things. On the other hand, you don't want to just switch every single policy the government does every
That's
like election.
democracy.
That's democracy in action. That's a lot of uncertainty you're unleashing.
That's what he's saying.
I don't know. Andrew Jackson was like
What does that think?
national hero because of the Battle of New
Uh,
Orleans.
Yeah, DC, and he was just like,
I'm just glad they left Hamilton on the 10 and instead of we're going to get rid of Jackson because Hamilton designed the financial system. Like him or hate him, like
he should be on
it's very appropriate.
Yeah, Jackson just kind of was like, I'm gonna shoot a bunch of people whenever I get mad.
it.
Well, he
I
had
love the
those
story when the guy tried to
circular
assassinate
thing,
him.
that worked
And then
out
he
The
pretty
gun
with his
misfired.
cane.
He beat the shit out of him. They had to pull him off him.
Yeah, because he was like 70 at that point, and he was still beating them with his cane.
My favorite story from his time in the military during the War of 1812. He kept trying to fight the British because he hated the British,
Yeah, but the war
but they
was
wouldn't let him do it. So they sent him down to fight. There was a civil war between the Creek tribe, so he got involved in that because a ton of like the settlers were killed, like collateral damage. His troops said they had no food. They had like nothing. He was like living on acorns. He had a broken arm, and like all the troops wanted dessert. And he said, "Fine." He put a rusty musket on the back of
Oh, yeah.
a mule, and he said, "Anyone who wants to go can leave, but the first person that walks away is getting shot." And none of them did. He then went down into this is in like northern Florida, like the Panhandle. He went down farther south and captured a fort from the Spanish, completely driving them out of Florida, and wrote a letter to the president saying, "I've captured Florida for us." The president hated him so much, he sent a letter and said, "Give it back." So he returned it to the Spanish. Okay, we got 5 minutes left, so take this time to write down, something you found the most interesting or you disagreed with in here, or even just give like a brief summary. Always forget to do this at the beginning of class.
Let's just not do it. I think it's okay.
Go back to my house.
You are?
Yeah.
Yeah. Max, we need to talk about your exam.
Huh?
We need to talk about your exam. Exam on Friday? You know what you're for? Yeah,
I'm not gonna be.
I totally forgot you were going with us, so.
I forgot I was too.
Yeah. Okay, so I can either give you a slightly different exam early, Thursday, or we can do it down there.
You do it then. I do it Monday.
We can do it.
You can. You can do it different. Some different questions.
Actually, I guess it was totally different than it would.
Yeah, like that.
Yeah, then there's no threat of sharing
Yeah,
that.
because I want to like go over it, we want to over it on Wednesday.
Yeah.
Yeah.
That's all we're doing.
I mean, I guess we could take it down and go over it. And it's going
I'll probably be bad if you try to do it during a break, like during the session.
yeah.
And it'll be late Friday night, so we're actually that fun.
I thought it was,
So, yeah, you can come in.
you said there's like a bunch of questions on there, you just pick out like,
Yeah,
right?
yeah, that's right.
Okay.
Yeah, no, that's probably the best way to do it, unless you could take it Thursday. Well, no, we're leaving in the afternoon.
Oh shit, what time are we leaving?
I think like the end of like the workday.
Like 5?
I think, I'm not 100% sure.
We can see that meeting at
Yeah.
3. I can do it. You wanna ride? No, I'm staying. You can do it.
I totally forgot you were on the trip.
Oh, yeah, you good. So, I can probably do it Thursday. You wanna be Thursday?
Alright, I'll leave it up to you. I'm gonna
Um,
do Thursday or Monday.
kinda let you know after Wednesday,
Yeah,
is that too late?
no, just let me know after class.
Okay, that way I can just see what the review's like, I'll look at the questions tonight,
Yeah.
tomorrow, and then, since I'm used to teaching already.
I don't think so. Alright, yeah, it's only 10% right?
Yeah.
I had the first time I took, well, Money Bank was the first time I took the class, and I was like so worried about it.
Mhm.
And then like, it was like, I was going to the final, I'm like, wait a second, that was only 10% of my grade.
Yeah.
I
I usually
spent like 3 nights like trying to memorize the answer to every question.
Oh, really? Well, tennis is just, we're mostly just like, you understand the basic theory, and you say apply to the question.
Yeah, that's basically what I'm doing. There's like 1 or 2 questions that's like,
About the.
that are on there that are like, the application of theory. Like, Ben Bernanke said this, the 3-year distance.
Okay. We have to know like people mandate like all that
No.
detail. Oh, I'll look at it, we'll go Wednesday and then I'll tell you after class Wednesday, that's cool.
Yeah, that sounds good. I put on the, this is all, if you're not there,